The Federal Open Market Committee has launched a monetary easing cycle with an unusually sharp rate cut of 50 basis points at once. At the same time, FED Chair Jerome Powell underscored growing concerns about the conditions of the U.S. labor market. Although he assured that the committee did not rush to lower interest rates quickly, the upcoming non-farm payrolls could provide otherwise. The issue is that it might happen quite unexpectedly for both analysts and traders. Experts say that the US economy needs to create up to 200,000 jobs per month to keep up with the growth of the working age population, or 150,000 if immigration slows down. And in one of his speeches, Jerome Powell mentioned 100,000 as the critical threshold for job growth per month. In other words, non-farm payrolls figures below this level are highly undesirable, as they could signal the onset of a recession in the US economy. Interestingly, the job openings and the private sector employment data from the ADP payroll processor published this week look quite positive. In light of this, experts suggest that the non-farm payrolls for September may turn out to be stronger than expected. In particular, there are doubts that the unemployment rate will rise from 4.2 to 4.3%. Most likely, it will remain at the current level. Moreover, the US public and private sectors are likely to create not 130,000 but 140,000 new jobs. Although this is not much considering the US population size and its growth rate, figures exceeded forecasts could lead to further strengthening of the US dollar. No wonder the markets have come to a standstill ahead of the crucial report. However, it's difficult for the dollar to stay static, as escalating geopolitical tensions boost demand for the safe haven assets. As a result, the US dollar index tracking the greenback's value against the six major counterparts broke through 102 yesterday. Nevertheless, the index opened on a Friday, consolidating in a range of 101.80 to 101.90. Overall, the euro-dollar pair remains in a downward corrective phase from the resistance level of 1.1200. Today, the euro switched to a defensive stance and rebounded from support at 1.1000. Hence, our analysts reckon that traders could cut long positions on the euro, and this in turn could lead to a rebound. The evident sign of an increase in long positions could be the consolidation of the euro-dollar pair above 1.1050. However, today, the opposite scenario is also possible. In this case, if the Euro-USD pair settles below 1.1000, it would support a further decline into the range of 1.0900 to 1.0950. The main catalyst on a forex today will be the government data on the US employment. According to the consensus, the non-farm payrolls for September could confirm that the US labor market is steadily losing momentum. The number of new jobs is likely to be roughly at the same level as in August, after a gain of 142,000 jobs last month. The US economy is expected to add about 140,000 new jobs. The unemployment rate is anticipated to remain stable at 4.2%. However, wage growth is expected to reflect the robust nature of the US economy and remain stable at 3.8%. While currencies on the forex are in a waiting mode, Brent crude futures jumped on Friday to a 4-week high, breaking their resistance at $78 per barrel. Over the past day, the Brent price surged by 5%, indicating significant pressure from speculators. And the speculative momentum driven by the information background still surprises traders. In such conditions, technical analysis takes a backseat. Brent crude is on a track to record its highest one-week gain since early January 2023. And this scenario is realistic today as the tensions in the Middle East continue to escalate. And it's a fair to say that the forecast of oil recovering to even $100 per barrel no longer seems so far-fetched. Our analysts suggest that oil prices could rise above $80 per barrel in the coming days. Amid the rise in oil prices, the Russian ruble is naturally attempting to recover at least some of its recent losses. However, the ruble is hurt by concerns over the future of yuan trading. There is a high likelihood that trading could be suspended as early as next week. So far, neither the Bank of Russia nor the Bank of China has provided any clarification on this matter. Considering that China is celebrating National Day until October 7, an answer to this question may only come over the weekend. Meanwhile, the ruble will likely trade sideways until the end of today's session as it's unwilling to take in additional risks in this uncertain situation. The yuan-ruble pair is in a pullback phase from its recent local high. However, no drastic changes are observed. The bullish sentiment still dominates the market. For this reason, if the instrument settles at 13.5, this could indicate a stage of growth. Otherwise, the price may gradually return to 13, where the yuan-ruble pair will continue to consolidate. That's all for today. We monitor developments in financial markets. Subscribe to our channel and stay up to date with the latest news. And see you on Monday.